Okay, welcome everyone. We'll start lesson 3. And this lesson will go through LO3, be able to interpret financial statement and make justified recommendation. So that's our LO3. We discuss LO1, LO2, last 2 lessons. Okay, so up to now, what we discuss about sole trader partnership, limited company and charities. We discuss few ISs. We discuss IS 16. We'll start in the series. IS 1, which is presentation and represent how we can produce and present financial statement. IS 2, inventories. IS 7, cash flow. IS 10 is called adjusting events. IS 16 PPE. We discuss IS 36 impairment. IS 37 provisions. IS 38 tangible intangible asset. Okay, and other than that, we discuss IFRS 3, combination of business, and IFRS 15 is revenue, how we can record, and IFRS 16. Yes, that's about leases. New IS. Yes, we discussed one of old IS as well, IS 17. That was old IS leases as well. Yes, where we used to, but now is the new is IFRS. Okay, then we discuss how many types of statement we prepare. That's we discussed in the previous lesson. Other than that, we discuss about ethics. PPCIO, Popular People Chat in Offices. Yes, 5 professional code of ethics. And today we are moving forward and we'll discuss. What do you think? Scale 1 to 10 now, limited companies and financial statement. We know how many types of statement. We discuss end of year adjustment sums. Yes, we discuss types of errors as well, how we can. We discuss accrual and prepayment. We discuss qualitative characteristic about financial statements. Okay, so hope we are somewhere in between 7, 8. Yes. Anybody, any question, please? You can reflect your end. If you have a question, please, you can ask and you carry on asking. Today lesson, indicative content, what we're supposed to learn. Calculation and interpretation of ratios. We'll go through liquidity ratio. What is meant by liquid? Anyone? Liquid ratios? Do we know what those are, liquid ratios? Anyone?
Yeah, this shows liquidity. This shows how much cash the company has to run the day-to-day. For example, how much current asset we have to be able to meet up our current liabilities. And the standard liquidity ratio should be 1.5:1. That means current assets should be at least 1.5 times higher than the current liabilities.
Excellent, great. So liquid ratios mean anything which convert into cash or cash itself. So those current assets divided by current liability that shows are how much liquid position as a company. So of course we can look around the quick ratios and the current ratios. Quick ratios benchmark is 1-to-1. 1 pound worth of asset, 1 pound worth of life. So we'll go in this way. We have 2 types of ratios under current ratios. Liquid ratios, or we call current ratios. So one is the current ratios, current asset divided by current liabilities. So that should be 2-to-1. Most of analysts say 2 pound worth of asset, 1 pound worth of liabilities. Then quick ratios, which is more because where we don't consider the inventories. That's, normally with a lot of analysts says, no, you're doing current asset divided by current liability, but you're minus it from here, inventories figure, yes, stock figures, because the stock sometimes people may be outdated. So now that's why we're looking this. And normally benchmark is 1-to-1. Okay, that's the key, for this is a benchmark, but it varies industry to industry. This is not hard and fast rule. You have to make your own judgment looking the competitor ratios or other companies ratio. And if you have question, you can ask please. Profitability ratio, where we can look around gross profit margin for suppose divided by revenue. Yes, we can look around operating profit divided by revenue times by 100. As a percentage, we can look around return on capital employed, net assets, and these all the ratios we normally look under profitability ratio. Then we have a working capital cycle, of course, inventory turnover days, received turnover days, and minus trade payable turnover days that show the working capital cycle. Efficiency ratios, how quick we collect the money, our use of resources. That's ratios we calculate. Resources utilization ratios we can use as well. How efficiently we use these. Interpretation of the ratios, comparison of similar companies, which justification, recommendation, usefulness of ratios, and we'll go through some gaps in FRS 105, 102 as well. Okay, so we have today 3.1, evaluate the accounting record of the specific organization. We can choose any organization. When we'll go through assignment brief next lesson, we can be more specific to address these. Make justified recommendation to process improvement of organization, analyze the usefulness of accounting ratios when evaluate accounting record, and evaluate international differences in the financial reporting. Yes, that's which we have. We can use local or we can use international. So micro and small and the medium size organization. So that's the financial reporting council are issued suits of the changes. They largely response to implementation of EU accounting derivative. So that's and the new accounting standard FRS 105, which is financial reporting standard, not international. That's micro entities, yes, regimes. New section, of course, a lot of section being added, so we can look around if we are dealing with the micro and within apply to UK and Republic of Ireland. Other changes necessary to continuous compliance with the company law. Really, that's the matter. That's really we need to do. And we'll review FRS 101. Yes, reduce the disclosure of the framework. That's international. Even the local standard is reducing. Yes, the workload and more making things more transparent. Those are the crucial. Okay, these changes happen and implementation dates we've been given. Yes, 1st January 2016, that FRC, Financial Reporting Council has made available overview of the financial reporting framework. That's and the few section within that 105 and 102. Okay, any question? If you have, please, you can ask. Okay, then a micro definition entity is contained the section 384 and 384B and the Company Act 2006. Yeah, they can be many, of course, that in Act, can be different sections. If those the qualifying condition of by the companies in the year, it does not exceed or more the following criteria: turnover 632,000, balance sheet total is 316,000, and number of employees 10. Reporting option FRS 105, FRSC 205, 1 year only. The section 1 and section 2, these are all the amendments happen, and that's which we can look around when we deal with the company and the requirement of the company to be submit the accounts. These are new financial reporting standards. Okay, then next we'll go through interpretation. That's the key topic really. Within that we have few elements which we discuss. So when interpreting financial statement, it is important and certain that who are the user of accounts and what information they need. That's the key. You identify the keys user of the financial statement, or we call stakeholders, and what sort of decision they make and what sort of information they require to make those decisions. As accountant, what we can do, we can only provide them true and fair information. They have to make their judgment either to go ahead or not, up to that. Okay, please, if any question, you can stop me and ask. Okay, so ratios are simply calculation based on the action in the set of data. For example, changing in the cost of sale directly linked to the change in the sales activity. The change in the sales activity have also effect upon the wages and the salaries and receivable inventory level. That's we need to be. If we change the policies, yes, cash and sales also affect, like we're not giving any more credit. This can impact our sales ratio or the revenue or the turnover. So that's also we need to be keep in mind when the company will do or make any changes. So we discussed about in the previous one of lesson that click debit and credit, but think about some people are very creative. They are really looking these ratios very closely and they can make the things adjustable and more attractive to the investors. But always we need to try our best, true and fair. So all these ratios formula will be given here. So current ratios, yes, current asset divided by current liabilities, interest cover ratios. So we can categorize majorly 4 categories of ratio: liquidity, profitability, financial position, also known as the gearing ratio. So when you have a debt to equity ratio, high gear, high risk. So we want to be make sure our company is less risky. And normally debt is cheaper than equity if you have reasonable debt up to 60 and 40 ratio. That's always is a preferable according to the various analysts. Yes, again, this is not hard and fast rule. It varies industry to industry, but our job to be give the true and fair information. Any question? Okay. Other than that, please, if you have question, you can ask. Yes, all these ratios formulas you've been given here, and I'll should be on Moodle. I don't know why I'm not showing you, but I'll ask Raman and I'll make sure, so send you all the stuff. So return on capital implied, yes, profit from operation, total equity plus non-current liability. Return on total asset, yes, profit from operation divided by total asset. Return on equity, then gross profit, expenses versus percentage we can calculate. So these ratios and these formulas, we can use it to calculate our ratios. Okay. Then the main objective of financial statement of the user economic decision. Yes, use in external to business need to be interpreted the financial statement, understand the financial performance through these ratios. Of course, ratios will help them. Ratios always we need to keep in mind the qualitative characteristic. We need to comparative figures we must need to give, because otherwise people can't make the right decision if we, and always we need to produce the timely financial statements. Okay, there are a number of websites, of course, they publish the information, financial analysis, we can use those. But as a company true and fair purposes, we need to be to make sure we'll give. So these are all the formulas all being explained underneath. Return on capital employed, may the return made, the company on the both loans and debt capital and the share capital. This we can, and there are the different formulas we can use it, no harm. Yes, but our answers will be the same.
Hello.
Yes, please.
Yeah, sorry. Profit from operations. Okay, is this EBITDA? Is it EBIT? At what level? Profit from operations.
Oh yes. So here is a question mark. Profit, it can be earning before interest and tax. Yes. You can do after the tax. Yes. But lot of people looking the before interest and tax. Yes. Okay. So we can do before interest and tax, and you can give after the tax, because especially as an investor, yes, investor really looking profit after tax. Yes. profit after tax and interest. Yes. Because interest is a finance cost when you borrow money for the long period of time. That's, normally you paying the interest on it. That's called finance cost under IS1. So if you do before that, your operating ratio will be high. If you do afterwards, your operating, because your actual operation is the income and expenses generated. Because the finance cost is mean you borrow the money, but that money you have invested in the non-current asset. That's why some in a list not preferred to, they just go profit from operation before interest and tax. Huh?
Yeah.
Okay.
I think that presents a better representation of the activities of the company at the day.
Yes, that's, because, but if someone want to themselves even, because we are giving the financial statement using the formula, they can do afterwards even. They can do according to, that's why the financial analyst, they say what really want to you, where you want to be invest. Yes, what you think, they can give them both. Yes, at least they have both, they can look around. How much tax company is paying, how much dividend, even dividend payout ratio or dividend ratio. Some year, yes, or EPS, earning per share, yes. That's also investor are very keen to look around. Because of course, earning per share is drop. So what's the point you will invest? Huh? If the company is issuing more share or the company has the policy give shares to the worker. So the free shares to the worker, well, ultimately more share in circulation, EPS will drop. Yes, but what will be bring, that the workers loyalty with the company. Yes, they can think they are honor as well. So that's, different interpretation can be.
Can I ask something there?
Sure.
How do we distinguish the calculation based on profitability ratio from the calculation using the EPS? Because it appears two of them are talking about the efficiencies, how best the management has used the assets of the company in producing profit. So,
yeah. So what will
why
go?
do we? Yeah.
We'll go through few ratios today. Yeah. And then we'll interpret them. Huh?
Okay.
So in the following slide, we'll use those and we'll interpret it. Huh? So we'll look all these. Huh? Okay. So these are all the ratio return on equity for suppose. Yes. Equity means share capital. You're looking profit after tax now. Because of course you're paying. So that's why people say debt is a cheaper, yeah, source of finance compared to equity. Why? Because the debt you minus for as expense. Yes, any interest you're paying on the debt, and you're saving on the tax as well. But when you have a shares issued and you're raising money through shares, because you paying after the tax dividend, yes. So it means on equity financing, you're paying still tax to the government, yeah. And then you're paying to the shareholders. Huh? And they expect higher return. Yes, minimum they expect at least 10%. But the debt we can get maybe 2% if I have a good credit scoring. Huh? Yes, or can be 4%. But only the problem, if you don't pay to the debt, your company can be higher risk. Yes. But if you don't pay the shareholders, maybe you sustain 1 year, 2 years. Yeah. That's, other question mark. Really, we need to look at. Here we percentage of the profit and expense. Yes. So sometime we're looking the delivery charge. How much is it based on the revenue? How much sale you're generating and paying the delivery charge? Maybe you're thinking about, come on, we outsource them delivery or not? Yes. So management can interpret these ratios for their own perspective, but everyone is maybe looking different perspective. Huh? Everyone's interest is a different in the company. Huh? So we can look around asset turnover. Yes, asset turnover, how much? Yeah. So you minus your current liability, because the current liability you have to settle, because the long-term liability mean non-current asset investment. So that's why we not minus it. Yes, you can do it net asset if you want to, but normally we just look revenue minus divided by total asset minus current liability, where the current liabilities mean the current short-term assets, yes, or overdraft, because that's not linked with the non-current asset. That's why we're not doing it. Okay, some people can look around even just total asset. Okay, as we discuss liquidity ratios, yes, then working capital cycle, yes, so inventory turnover days. So you can look around inventory turnover, how many times inventory been turnover, or how many days required. Of course, we want to be shorter period. Trade receivable, we want shorter than the trade payable. Trade payable maybe 60 days and trade receivable 30 days. So that's why 30 days you have a safety net. You have a cash flow more. That's we need to be look around, yes. Especially when you prepare the management account and you want to give the views to your clients. Yeah, that's, interpretation of these ratios can be like if you're using QuickBook, and in the QuickBook, of course, will create all the ratios and you can include the comments underneath when you publish. Yeah, and even it's quite good, software to use. Sorry, especially Zero, yes, to prepare the management account. Any question? Okay. So these are all the ratios which we can. Then gearing, yes, as we mentioned, gearing have some analysts use net non-current liability divided by total equity, or just this ratio. Yes, because why we are adding in non-current liabilities again? Because the non-current liability is a part of investment in the non-current asset. That's why. Okay, other problem, especially this ratio is very keen. They are looking banks profit from operation, yes, divided by the finance cost. How many time profit is higher than the finance cost? Yeah, 3 times, 10 times, 4 times. Yes, if the profit drops, so they want to make sure their investment is secure or not. Okay, so that's one. Here we're looking 2 companies we have. Yes, let's assume it's a separate question we have as well. So we have a 2 company. One is called Anika, other is called Papika Limited. Yes, let's say 2. It's the same year. We're looking now. They have a gross profit 45 and 52. Then operating profit is 9 and so if the gross profit is 45 and the operating profit is 9, where is the other percentage gone? The difference between 45 and 9. So how many
operating expenses? That's OPEX.
Yes, those are your overhead expense. Yes. So your how many percent is it around? Yes. So that's your
That's around quite a lot, 36%.
yes. So that's your going toward your gross profit came 45. Yes. And your operating profit came 9. The difference between 45 and 9, how many percent?
36%.
36% your overhead cost. Yes. So as a manager, you can think about how we can reduce overhead costs. Yes. Because the 36% is going, you can look around against your competitors here. They have a 52.5 gross profit and 11. So if you do difference between them, so how many percent there? They have overhead.
41.5.
41.5. Yes. So they have overall gross profit, but they have a direct cost, which is cost of sales is a lower. Yes. That's why they have a higher percentage. Yes. 52.5. Or they charge a high price. Yes. That can be reason. Then we look the gearing ratio. This is 13 and this is 71. Which one is the more risky, which is running by the debt ladder? Yes. So this is Papika is more
Papika
risky.
is more risky. Yes.
More risky compared to Anika. Yes. So that's other way. Yes. If you just want to look around the debt against the equity percentage. Yes. This is 15. So only they have a 15.29% debt. Again, equity mean is your investment. You own the company. Debt means someone else own the company. Yes. Bank own it. So bank own it 15.29 and you own it around 84%, yes, which is good, yes. So in other company, Paprika, really look now other way around, yes. 245% is owned by someone else, yes. That's, because the debt is, so this company can be collapsed anytime, yes. But of course, we say higher the risk, higher the return. We normally use the word beta. Yes, beta is called risk factor. If you have a higher the beta, higher the risk, higher the return. But how much is a higher here? If you see here, 2% only, yes, 2.5. So you taking too much risk to be invested in Paprika, yes. 2% to earn higher, yes. This company, because they have a gearing is very high, they can collapse anytime. Any question here? Yes or no?
No.
Okay. Yes, this is one of, we quoted example. We can look around the whole. And then interest cover ratios, for suppose, yes. This is coming 11.6. What is 11.6? 11.6 times their profit is higher than the finance cost. But this one, Paprika, is only 3.1. So Paprika's profit against the finance cost is only 3.1 times higher, yes. So if their profit drop next year, if we drop 2 times, 3 times, 4 times in Anika, yes, still we'll get it money back, yes. So we can decide the interest rate as well, yes. Because it's a very risky to give them borrow money, yes, lend them money further. Maybe they can't afford it to pay back us. Yes, because they already run on the debt. They have a very high gearing ratios. Asset test, yes, which we said 1.2. And this is, so you will see there we said benchmark is 1 to 1. And this is above than the benchmark, yes, which is good to be invest in Anika instead of Paprika. Okay.
So what's the benchmark for asset test ratio? This interest cover ratio.
Asset test ratio is 1 to 1. £1 worth of asset, £1 worth of liabilities. Huh? Yeah, it's mean
So
current asset your £1 and same your current liability 1 to 1, which is fine. Yes, that's the suitable. Yeah, because you're taking out the inventory figure. Then in universe, especially in companies, inventory is the key element. Like no, you have to think about, is it Tesco? Yes, Tesco has the inventory. If you're taking out inventory, yes, maybe yes.
Sorry, I think it's interest cover I'm asking, not asset, not quick ratio.
Sorry, which
I'm
asset?
talking about interest cover ratio. What is the standard?
Okay, interest cover ratios. Always you say around 5 to 7 times higher. Yes.
Okay, I think it will be interesting in all these ratios to also mention to us what are the standards. I mean, the standards, so that because
okay,
the benchmark.
Here you need to be think about which industry we are in. Yes, compare with the competitors. Yes, and look the industry benchmark. Yes, because this is not, yes, because especially think about in supermarket, they are always running on the loans. Yes, they always have a stock, yes, and then it varies. But when think about the food industries and other industries, yeah, interest is a finance cost, is all on the non-current liabilities. Yes, if you have a high, so finance cost, but the again, is it profit or a high or not? Yes, that's because this is even your 11 times our profit is a higher than the finance cost. So 11 times we are higher. So even we drop 3 times next year due to the COVID-19 or 4 times, still we can sustain in a business. Yes. And we can pay the interest, whatever liability we have. But in terms of Paprika, this company is 3.1. So if it drops, what they will do? Yes. So at least, the lot of analysts says you look more than 5 at least. Yes. More than 5 times. If you drop 1 times, 2 times, still you have a possibility you will get your money back. Huh? lender point of view. Okay. So other the company performance may be compared with the previous year performance, past result. Okay, some again here is a question mark. Creative accountant, yes.
Mhm.
So what the creative accountant do, they can change the costing methods, yes. I'm not sure you're okay or you learn about marginal costing, yes,
Mhm. Mhm.
and absorption costing. Anyone knows what the key difference? Yes or no? Okay, marginal is mean all the variable costs, yes.
Mhm.
And then the fixed cost we minus as a period cost, yes. Whole cost we minus as a fixed cost, yes. And then we'll get the profit. But when you're using absorption costing is known as a full cost.
Yeah,
Yes.
so you
So
absorb the
where
fixed cost. You
fixed
absorb the fixed cost.
and variable cost you observe into your closing inventory value, yes.
Yeah.
So the closing inventory based on your fixed and variable, but under marginal is only. So if your closing inventory you have in stock, so that observing your cost is increasing your profit. Yes.
Mhm.
So what you can creative accountant do, that's why the standard says under IS2, you can't really, if you want to change your costing method from marginal to absorption or any other, you need to be change the figure of the previous year as well. So the
Hmm.
comparative figures, otherwise you can creative, you can increase this year profit, yes.
Hmm.
And that's, lot of, the people just a creative accountant carry on doing it, yes. Okay. Yes, we can look around. There is not hard. We need to look around the limitation. We need to look around other things. Yes, it's called economics factors, political, economic, social, and technological. We have a base rate. It was 0.01%. Yes, it went up to 0.25% now, and it went up to further is 0.5% interest rate. So that's also impact our economy. Yes.
Hmm.
So we have to look around political. If labor are conservative, we're not in a politics, but just you need to be look around what is the manifesto of the company, who will be in power. Yeah, that's also impact in the future because you're looking these ratio for the future, your decision. Yeah, you want to invest, you want to apply the jobs with them. Yes, you want to sustain, you want to get the role there, or you think you will grow there, but because these companies are risky, if they can't afford it or they financially struggle, it's mean your job will be risk. Unemployment rate in, yes, where we can get the information, Office of National Statistics.gov.uk. Yes, what is the per capita income of country? Yes, so we have around, a dropped 47,000 to we are now nearly 39 according to World Bank. Yes. So we can look around the company corporate governance board of, is it there are the non-executive, there are the enumeration committee, yes, or just one person. There is a tier system in the board of governance, how well the company control and manage, what their strategic plan for future. That's all things is a crucial, not just the ratios. Ratios itself is also give you indication, but you look around what's the future plan. Maybe they are restructuring, a lot of restructuring cost happening. Always we need to ask the question. Yes, we can compare with the industry. We can look around same size of the companies. We need to look around the limitation of ratios. These, okay, the ratios may show the particular weakness in the company. Has the business plan to deal with these weaknesses? Yes, it can be. So like trade receivable days, trade payable days, and no, you want to change it. Yes, if it's supplier, they are very keen to look around how many days you paying it. If you like Morrison Bean and even the Tesco Bean accused, they paid 15 months small farmer. They took 15 months to pay them. Yes, their money. So 15 months is a huge, yes, what the small farmer will do. They need cash as well quicker. So inventory turnover days, yes, that's always we need to look around cycle. Yeah. always good to be look around, because as quickly you do things, it means you're using your resources effectively. You're converting them, you're maximizing your return. Okay, yes, this is all stock of user and what decision they can. Yes, investor help to determine whether to buy, hold, or sell, assess the ability of the entity. Potential investors also help to determine the buy the shares or the bond, or the lenders they're looking, supplier also looking, and the customer and the government and the public. Yes. So these are all different contribution, different decision they can make, based on the ratios. Okay, so as we look the Papika and Anika, gross profit is a better. So we can conclude in the conclusion as an analyst. So main concern is the riskiest. Yes. Papika is much more. Anika still have the perfectly acceptable profit levels. Yes. And clearly Papika is the more risky and less solvent. Yes. So we need to be real danger to be. So we need to be make sure we can, as an analyst, we can draw the conclusion final on the basis of ratios. And we can conclude for our clients if we need to. Especially in management accounting, we can look around budget side, the cash flow, cash forecast, yeah, their policy is outstanding. So these are all the areas we need to look around. Any question? Okay, other than that, please, like I can show you, which I send you the stuff. Okay, I think so. I not send you, we can send you this. I can send you the handouts, these as well. Yes, the company laws, which you can do some question with the answers. Yes. So you can use the ratios. Other than that, I'm going to send you the booklet. In the booklet, please, you can use it for ratios especially, or you want to look around any other question. So just share with you in a minute. So I hope so will open. Okay, so these are, please. So what we need to do. So we need to look around these, very closely. Yeah. And thus we have the chapters. Yes, you will see here. Yes. IS is earning per shares for suppose you want to look around, or you want to look around interpretation of financial statement, chapter 21, please. That's really good to look around just for the ratio.
Yeah.
Chapter 21. So in chapter 21, we've been given pages 279. So 279, click there. So we can look around 279. If you go down. Yes, this one. You will see all the ratios, formulas. Yeah.
Yeah.
And then you've been given the examples. Yes. 2 years. Yes. And then you can calculate these ratios. Yes. And then you can given the answers. Yeah. And interpretation. You can look around debt equity. Yes. These, all the little bullet points is good to look around. And then that give us good, yes, limitation of ratios. Yes. And there, I already uploaded, it's called, yes, some, non-profit organization, they are 3 E's, they're looking the effectiveness economies and how they maybe not really profitability they're looking. They're more including the customer satisfaction, their stakeholders, because they have to serve them. So there are the good, few questions there. If you want to, that's you can look around. Other than that, please, if the article, lot of articles carry on. ACCA also publish and various other. So if you type ACCA article on ratio analysis, which I uploaded once, twice, I think. So it should be on Moodle, but I'll recheck it in the back office are uploaded or not. If you type next to that PDF, you can even download the PDF format. So you will see here, yes, ratios, ratio analysis questions carry on coming with this interpretation of the ratios. You will see there, yes, this is lot of good explanation. So maybe that's also is looking all relevant. Any question, anyone?
Can you kindly send these things to our emails, please? Because personally, my phone can't download anything.
No, definitely. I'll make sure I'll send you what I send you via WhatsApp as well. Yes, these two types. So there will be 4 books. Yes. So we use level 4 and level ACCA ones. Yeah.
Mhm.
So you can do, well, let's say you're thinking, come on, I need to little bit polish about the cash flow. Yes. So you can look around the cash flow chapters. Yes. Which is after the ratios, you have a cash flow chapter. So that's you want to look around associate, yeah, which we discussed, consolidates, and you think, oh yes, I'm dealing with the client and they have, so there are the questions, huh? So by doing 1 or 2, that will help you to yeah, and that's which I can send you. So this is the tutor copy and this is the student copy. Yes. So student copy is a question and the tutor copy is the answer. Huh?
Yeah.
So like if you're dealing anything, yes, like you're looking foreign currencies issue hedging, yeah, you want to look around the leasing, yes, or you want to deal with the intangible asset, like a goodwill, you want to deal with the impairment, yes, you want
Is
to
there
deal
anything,
with the
is there anything like charities?
yeah. So you can deal with the charity is a separate, of course, it's a charity commission guidance further, yeah. But as a non-profit organization, that's the type of ownership, yeah. So this is the introduction to publish accounts, yes, for various companies, yes. That's we can look around the chapter. Okay, so we're dealing really this subject point of view. We have understanding about overall the statements. Yes, some ISC and ratio analysis. Yeah, that's the key. Yes, there was a question about the cash flow. Yes, at least we can look around how many we discuss investing, operating, investing, and financing. Yes, 3 activities. We're looking where the cash being used. Yes, and end of the day, cash balance is the cash balance whichever you've been given in the statement of financial position, or you will show. Only we want to show in the cash flow where the cash came and where the cash being utilized. So investor, if your cash is being utilized under the investing activities, yes. So this indicate the future in the future company will generate cash, yes. Because you have an investment. Currently your cash balance is lower, but you have an investment in the non-current asset in infrastructure. So that will bring the more cash in future, yes. And if operating is a running expenses, yes. And the running of the normal operation will generate you. If you have a good cash position, but that's your financing activity make the position of the cash good, it mean in future you have to pay the liability more, yes. So this, this is all the interpretation which we can use it. Okay. That's the way, we can look around. Yes, please. In terms of next lesson will be a assignment discussion. So please join and we'll go through how we can prepare the assignment and address all the learning outcome. We'll arrange some samples for you as well. So we'll go through accordingly.
Okay.
Okay. Anybody, any question? No.
Maybe I have a question.
Yes, sure. If you have
Yeah.
now.
So after next week, when are we expecting to submit the assignment? Normally
Yes.
after.
Normally we prefer to be we request student if you can submit within 2 weeks after the assignment discussion, yeah.
Okay.
And
So
within 2 weeks we'll give you, so we can within 4 weeks we can sign off your unit. Huh?
Okay.
So if some people need time, so we are flexible, but it means we are missing this badge, yes, we can include another unit to sign off here.
Okay. Okay. Then my second question is okay, this is a little bit outside the topic for today. Yeah, I know that the Institute of Financial Accounting has been around for so long, but it seems not many people are aware of it. And I was just wondering if what measures the Institute is taking to make it known. you know, like many people seem not to know about it. I know ACCA, they did a lot of marketing and all that. That is why they are known all over the place. I don't know if the institute is doing something in this light.
I think that question should be directed to Susan of this issue, because UK Versity, I don't think it's a branch of the institute, IFA. So that question should be directed to Susan.
Yeah, I mean, you know, that's the IFA matters because the qualification ATHE is approved by the IFA. So that's, you know, they give you the membership stuff. And of course, in terms of the standards, all awarding body, this should, but I think so IFAs compared to ACCA. ACCA and CMA publish, you know, more of articles on these issues, or they do carry on doing CPD sessions on these. So really, you know, it depends because all the legislation changes. It's maybe you're not dealing everything really. Yes. And you don't need it everything. But depends, you know, what sort of your nature of clients and yourself. Yes, always good to be, we have everything, but maybe you're not tax expert. Yes. And maybe you think more about tax now. Yes. Because that's other area, you know, tax is a different thing compared to the accounts. Accounts is a different thing. So that's we need to be look around. Yeah, always good to be, please. It's simple. I think so. It's a good if you set up account on open tuition. Yes. And look around because that's, you know, that's open tuition is absolutely free, and they carry on doing, you know, the things on these things. Yeah. And you can watch, you know, few like I want to be polish myself IFRS. Yeah. Yes. Or you look around world, you know, the international accounting standard new. You can subscribe yourself. They carry on sending you the stuff. Huh? Yes. And that's, you know, will carry on be keeping you up to date with the knowledge. Huh? Because that's other big areas. Huh? Okay. Thank you. Many thanks. Anybody else? If you have a question, we can.
That's good. Cheers, Adam.
Okay, brilliant. Have a lovely evening and speak to you next week. We'll go through assignment discussion and thanks for joining.
Okay,
Thank you.
Bye-bye.
Thank you for teaching. Bye.
Welcome. Thanks, player. Bye-bye.